let's take a look at the broad markets picture. First of all, your sense of the activity that we're seeing filter through yesterday, the index managing a marginal increase and edging into positive territory.
Yes, the market has shown an increase for the fourth day in a row. And although the volumes are quite thin, I think what we're seeing right now generally in the market is speculators looking for bargains. And also the market has been driven by rumors on the bank recapitalization exercise and also potential passing of the PIB and Shell divesting some of its shares, some of its assets.
I want to take a look at players involved in that recapitalization process and specifically the M&A activity that we're seeing within that banking sector. We were talking about Access Bank earlier this week and the possibility of it being exposed to execution and integration risk if it does go through with the transaction. The broker I was chatting to saying that's pretty limited. Now that we've heard that it's one of the banks that's involved in the deals and that it will have a name change as well, do you share that sentiment?
No, I think integration could be difficult. And the reason why is that a lot of these banks, especially some of the rescued banks, came through consolidation in 2005, and some of them were less successful than others in consolidating in the 2005 period. So integrating their systems when they are not fully consolidated could be an issue. And then you also have to look at things like the staff, brand, and various other options. So I think it will be more difficult than people envisage.
Of course, we are looking at Access Bank tying up with Intercontinental Bank. I mean, what are you making on the surface of a tie-up like that in terms of synergy and what we could be expecting moving forward?
For Access Bank, it's a game changer. It gives them size. The actual assets of Intercontinental will be a big increase for Access Bank and will take Access Bank into the top tier of the Nigerian banking sector from the mid-tier it is now. So it is a game changer from that point of view for them in terms of assets. In terms of consolidating and putting the Access Bank culture within Intercontinental, that will be more difficult. But I think for someone like Access Bank, this is the kind of transaction they require to actually go into top tier of banking.
Of course, the expectation is the bank is going to participate in general increase in lending to key sectors like the oil and gas space, even if it does remain a Tier 2 bank. And in addition, we've heard that Tier 2 corporates will drive loan growth moving forward. Do you hold that same kind of expectation where historically the target market has been for Tier 1 corporates?
The hope is that all the banks, including Tier 1 and Tier 2, will start lending to the real sector. The issue is that a lot of these banks had very poor risk management frameworks, and that is really the main issue. And in a sense, it's easier for them to lend to big multinationals and top corporates because it's easier. The credit work you're going to do on those businesses is probably the same for a smaller corporate, but you probably have bigger returns, and the risk is probably less. So I think unless all the banks, which they are doing at the moment, can improve their risk management framework and get qualified people into the actual proper credit analysis, it's still going to be difficult for them to lend to the real sector, especially now CBN is upping its regulatory supervision of any such deals. Just
as a quick aside, we've seen a player like Diamond Bank see a shift too, where its retail business is becoming increasingly relevant and now accounts for about 8.5% of the total loan book and 40% of total customers. It's a strategy that seems to be paying off, isn't it?
It is, but I think for the retail strategy in Nigeria is difficult in terms of retail banking. The two big areas generally in the world where banks do well is consumer lending and mortgages. Consumer lending in terms of mortgages and also credit facilities like credit cards and other lending to retail customers. Now in Nigeria we have an issue with identifying and tracking lenders. The credit bureaus have been registered by CBN and they're working towards creating a database of lenders so that a database of customers that have borrowed money so that lenders have an easier way of tracking lenders. But all that is in the infancy. And I think to actually grow retail banking towards more of the unbanked, where the real growth should be. Because at the moment, most of the lending in the retail sector is to salaried workers, where it's easy to track them as long as they keep their jobs in the multinational firms they work in.
Coyote, one of the other tie-ups we're looking at is First Bank and Oceanic. Of course, First Bank is always ranked amongst the favourites in the banking sector, amongst the big caps. What do you see Oceanic bringing into its stable?
Again, this tie-up is for First Bank seems to be to kind of consolidate. In a sense, Oceanic has assets and a branch network which would tie in well with First Bank, although First Bank already has a very expansive branch network. I think the main thing is Oceanic's real focus was on the SME sector, and also in terms of trading and small enterprises going forward, which First Bank generally has been weaker in. So I think a big aspect of that tie-up is to get the synergies from Oceanic's previous focus on the SME and growing trading networks there. So I think that's what First Bank is really after.
And then we've got First City Monument Bank fusing with FinBank. First City Monument has seen a gradual improvement in the cost-to-income ratio. The risk factor that seems to be standing out there, though, is that its retail franchise is the least efficient of its business segments, with the CIR rate at 176%, NIM at 3.9%, and still making losses. So what are you making of the timing, and what exactly FCMB is taking a bite at?
I think there are two things really FCMB is taking a bite at. If you look at their retail numbers, I think part of the issue there is what we were discussing previously, is that it's very hard to keep track of retail consumers who lend, and especially if they go delinquent in their lending. I think in terms of FinBank has a strong e-banking platform. And the e-banking platform reduces the costs, because with a strong e-banking platform, you need less branches. I think FCMB wants to tie up with that e-banking platform. I also think from terms of FinBank as well, for FCMB, is that the FinBank has had has focused more on the retail than the corporate end, while FCMB has been the other way around. So I think FCMB is trying to tie up where they will look at the e-banking, especially the e-banking sector of the retail of FinBank, and tie in to improve their overall retail offering. But a combination of both also makes FCMB a bigger bank, and so they can do bigger ticket deals.